In the name of God, the most merciful, the most beneficent. And today's lecture, we are continuing with chapter B, section 2, long-term financial management, and in this, about financial instrument, debt financing, that is for bonds. So, about bonds, we have given in 2 lectures, and this is the first part of the 2, in which we will cover the basic features of bond, about maturity, par value, coupon rate, provisions for redeeming, conversion provisions, covenants, options, indentures and restrictions, and all about it. And then in the next lecture, we will cover the advanced level, including value of bonds, duration as a measure of bond, interest rate sensitivity, and impact of income tax bonds related to financing decisions, and all these things. A bond is a debt instrument, a kind of loan issued by the corporate companies or government for a period of more than 1 year. Usually, bonds may be bought on a short-term bonds, that is 2 to 5 years. Medium term can be called as intermediate bonds, 5 to 10 years duration, and long-term bonds 10 to 30 years. The investors acquiring a bond earns interest by lending money, because the return is not profit, it is interest. That's why it is called debt financing. The bondholder are not shareholders, and they are like creditor or lender. The issuer of bond, that means the corporate company or the government, are to be called as the borrower in this sense of debt financing. They get needed capital, cash flow. So here is the diagram. It shows the relationship between the investor and the corporate company, who are called as bond issuer. It can be a government or company. So the bond issuer, they need debt financing. They determine in accordance with their capital structure need for funding their assets. So they issue bonds, and the investors who see in the market and they want to contribute or invest their money in these bonds, so they send the flow cash to the corporate, and it will go as a capital, and it can be regarded as a loan. But in return, as a reward for this capital, this debt, so the bond issuing company pay back the interest, periodical interest, regularly to the investor, and they are called coupons. The par value or the face value of a bond is the amount that the bond issuer has borrowed from the investor. So that's the bond, that will be the par value or face value, and the total sum that the investor pays to the bond issuer will be multiplied by the number of bonds certificate, number of bonds multiplied to the face value or the purchase price, that we will see in detail later. The fixed rate of interest, that is called coupon rate, to be paid by the bond issuer to the investor, and that can be multiplied by the par value of the bond on the rate of the coupon rate. For example, if coupon rate is 3%, par value is 10 lakhs, and so the 3% means for this 10 lakh worth of total bond value will be 30,000 annual interest payment. So that's how the calculation. So fixed income, when we say fixed income, the amount received in coupons at regular intervals is the investor's fixed income per year. So they get by way of coupons. Sometimes, in most of the American companies, the coupons are semi-annual. So, for example, if there is a 6% per annum interest rate and 6 months coupon, they will get 3% of the on the par value. So 6 months 3%, another 6 months 3%, so total becomes 6% per annum. So this is how this calculation has to be done. And bonds are typically tradable. Okay, as market prices vary from the par value, the current yield of a bond is the annual interest payments of the bond divided by the bond's current market price. So how it is to be calculated, and all these things will be studied in this lecture in detail. Okay, and there are various types of bonds. All these things we will be studying in detail. Basic features of bond. So the terms and conditions for the issue of bonds are pre-decided at the time of issue as part of the bond indentures. So we'll have to understand certain basic features of the bond. So it covers the face value, what is meant by face value and all these things. We'll be studying in detail, and coupon rate and kind of interest rate that we will see in detail. Coupon payment frequency, at what frequency the interest payments are made, maturity date of the bond, and redemption value on the maturity date, and issuer details, and their credit rating by rated agencies, and covenants or like kind of certain conditions, restrictions put on the issuer based on the bond agreement, and market value of these bonds, and the yield curve also. So we will study in detail one by one. Bond principle. It is also known as par value or face value. It represents the currency amount of the bond and is the amount the lender is repaid when the bond matures. So that is the principal amount, you can say. Most bonds are denominated in increments of thousands of dollars. For example, a corporation issues bonds with a total face value of $100,000 on January 2, 2010. The stated interest rate of the bond is 8% per annum. The bond's maturity date is January 1, 2015. So that means 5 years kind of short-term bond. Okay. So in case if the face value of each bond is 1000, then the total number of bonds equal. So you can say 100 number of bonds. Bond interest, also referred to as the coupon rate. Generally, it is comparable to what other bonds being issued at that time that the interest are being paid, and it can be compared with the market rate. Three common forms of these coupon rates are: one is the fixed coupon rate, and floating coupon rate, and zero coupon rate. So for fixed coupon rate, interest is paid consistently at the same rate. Bonds are classified as fixed income securities if the coupon rate and the amount of bond payments are fixed at the time the bond is offered for sale. This is why generally these bonds are considered as conservative investments and less risky than stocks and other types of investments with highly variable return rates, because it is fixed coupon rate, so it is less risky. It's considered as less risky. Floating coupon rates, interest varies based on economic changes. Actually, after the initial issue, the sale of a bond, bonds are bought and sold through brokers in the secondary market, similar to the way stocks are traded. A bond's price fluctuates in the secondary market due to the fluctuation of market interest rates. If interest rate falls, the price will rise. However, the floating coupon rate may be kind of fixed to a market rate of certain thing, so that because of the because of its alignment with the economic changes, maybe it is preferable for when there is a floating volatile market. The zero coupon rate, there are no ongoing interest payments because the bond is sold at a deep discount and redeemed at full value as compound interest accrues up to the par value. We will see with some example how this is working, because in the zero coupon rate means it is no interest payment, but it is like a kind of discounting instrument. So that we will see in detail with some examples. Coupon payment frequency. Normally when we say that interest rate, it is per annum, but it is not necessary that all the coupon payment has to be annually. It can be at a different frequency also. The issuer can choose that. A bond's coupon rate is expressed as a percentage of the par value, and the issuer may decide on the frequency of payment. In the US, interest usually is paid semi-annually, that means every 6 months. Example, if a semi-annual bond has a 7% coupon, the issuer pays bondholders $35 because the 7% coupon for a $1,000 par value bond means it is $70 per annum. But if it is semi-annually paid once in 6 months, so it will be 50% of that, it means 35. So that is actually 3.5% every 6 months. So per annum rate will be 6 months plus next 6 months, so it is total 12 months, so it is 7%. So that's how this is. So students need to be careful when the questions come, whether it is annual payment or semi-annual payment, or what frequency it is there. Accordingly, they have to adjust the coupon rate. The coupon rate is usually quoted for per annum. A zero coupon bond is an exception as it pays no interest because the face value is paid at maturity. Initially, when the bonds are sold, issued, it is purchased for discount value. So the discounted amount is the reward, the return for the investors. So that is how it should be seen. Unlike the past, the vast majority of newer bonds are issued electronically, similar to stock purchase, and the interest is paid automatically to the bondholders through electronic banking. So it is automatically transferred. However, many coupon certificates still exist as they have not yet reached maturity. So that is also there in float. The rate of interest of a bond is influenced by 8 primary factors. So we will see in detail about these things, like kind of risk-free rate in the market, like US Treasury bill, and implied inflation factor, and credit or default risk of the corporation that is issuing the bond, liquidity of bond, what is the maturity date of that, and tax status of bond. If the government is giving any tax consideration, usually the interest expenses are tax deductible. So if the tax rate is changing, so there will be a benefit also on that. The time to maturity, relationship between the maturity of a security and its rate of return, that is defined by the term structure of interest rate. So that also we'll see in detail. And it is also called as the yield curve, and the term of bond traded in the secondary market creates another risk also. So that also we'll study in detail, a kind of risk of loss of principal due to general increase in market rates, which leads to a decline in the market value of the bond, and special provisions regarding bonds. An example is a call future, which gives the issuer the option of buying back the bond prior to its maturity at a given price. So all these things we will see in detail one by one. Bond agreements. It is a kind of written legal agreement among all parties involved in a bond issue. Also, called an indenture or deed of trust. An indenture defines the details, the kind of following details. It will be like a printed agreement in which the corporates and the bondholders sign and stamp. The terms and conditions of the bond issue will be there. The stated interest rate, the coupon rate will be there, and maturity date, what is the time of maturity, whether it is a 2-year, 3-year bond, 5-year, 10-year, 30-year, all these things. The protective covenants, that means if there is any restrictions placed on the issuer, such as maintaining certain financial ratios, any conditions, all these things will be part of these covenants. And conditions defining default, what is to be considered as defining the default condition within that. And any subordination, if subordination is that you have to understand that at the time of liquidity, whether the status of that the bondholder will be standing at in priority to, if there is, whether it will be on senior grade or junior grade or subordinate grade. So that depends on the availability of the redemption options, the settlement, whether they stand in priority over others or they will be subordinate to others. So that is the idea of that. And sinking fund terms. So what is sinking fund? It means it is a kind of arrangement of periodical installment based deposits created for the purpose of liquidating the debt when it comes to maturity. So payments made by the borrower to a separate custodial account, so that will be paid, keep on paid for that, used to repay the debt at maturity or periodically and assure creditors that adequate funds are available. And callability of the bond, if the issuer can call it before even the maturity date to redeem the bond. And conversion features, if that bonds can be converted into preferred or common stock, so that is the idea of that. And collateral property to be pledged, if any, if there is any collateral for the purpose of security, it has to be done, and that will be part of the agreement mentioned clearly. And designation and duties of the trustee, we have studied already. There should be a common trustee. If the corporation wants to issue bonds, they have to appoint a trustee. They can be a banker or intermediary persons, and they will be contacted for everything, even for the legal front. They will be responsible for suing even the corporation on behalf of the bondholders when there is a need. So that is the thing. So the bond agreement will state that clearly about the appointment of these trustees and the duties and responsibilities also. Okay. Restrictive, or generally it called as covenants, protective covenants, limit the actions that a company may take during the term of the agreement. So this within the bond agreement, so this is the covenants. Basically it is set by the bondholders on behalf of the bondholders, restricting the company, the issuing company, the company which is issuing the bonds. So that is the main part here. There are two types of covenants. One is negative, another one is positive. So the negative covenants limit or prohibit the borrower, that means the corporate issuing the bonds, from certain actions such as paying too much in dividends. They cannot pay too much in dividends because they have to retain some retained earnings in order to settle the bond coupons or maybe redemption of the bonds in time. There should not be any liquidation problem. And they are restricted also to pledge assets to other lenders. They cannot, because the people who are investing on the company is trusting the assets also. So they cannot pledge without the proper agreement. So one of the covenant will also restrict that. And They cannot sell major assets also, and they cannot merge with another firm, and acquiring more long-term debt also not possible. These are all like negative covenants. These any or all can be part of this kind of covenants. These are all examples. Okay. And what are the positive covenants? It specify actions that the borrower promises to perform. So the borrower, that means the issuing company should promise that they will perform. That means they will say that we will maintain certain financial ratios, we will maintain the liquidity ratios, we will maintain the working capital properly. So these kind of promise will have to be maintained. So they are positive covenants. Okay, they will say we will preserve this collateral in good condition. If there is certain parts of the assets are like kept as collateral, they will maintain it in good condition. Okay, in order to make it protect the value of it for the purpose of redemption, liquidation time. And also they will say that we will make timely interest and principal payments. That also will be a promise. And what if a failure to abide by positive covenants could place the bond issuer in default? So upon the failure, they will be treated as default and the law will take place, as the case may be that they will be as a defaulter. And we have to see a short note on bonds administration. How the issuing corporations are administering these bonds. Bonds are administered by qualified trustee. That is important. Trustee is the third party. There may be individuals or group of people, kind of association or institutions, or even banks chosen, but they are chosen by the bond issuer to serve as the official representative of the bondholder. But it will be visible on the bond agreement, everything, who are chosen and how the appointment was there and all these things. The responsibilities for this trustee include authenticating the bond issue's legality. So, for issuing, the regulating bodies are there, so they have to get that authentication, and ensuring that all contractual obligations are carried out as per the contract, and ensuring that sinking fund and interest payments are properly paid and applied, and initiating appropriate actions of the borrower does not meet obligation. If there is any of the obligations, either as per the covenant or the standard rules applied for bonds, so that they will have to ensure that they are taking their actions. And representing the bondholder in legal proceedings. This is also one of the important. They have to represent the bondholders, okay, not the issuing organization. And they will be administering the redemption also at the upon the maturity or at the call for redemption. The issuer of these bonds compensates the trustee, which will be included in the cost of borrowing. So issuers and types of bonds, some short notes. So corporate bonds issued by large and small US companies used to finance growth, expansion and other activities. So they are called corporate bonds. What is government bonds? So backed by the full faith and credit of the US government. So that's we have to see the government bonds for each country also. Used to sustain government operations and pay interest on national debt. So examples include US treasury bonds, treasury notes and saving bonds, etc. So what are municipal bonds? Issued by various cities and states. In US you can say it is United States, like various states are there. They have their own even tax plan, and so they issue various bonds. They are called municipal bonds for each city, for various cities and states. Used to pay for construction projects and other activities within that city. And agency bonds issued by various federal, state and local government agencies. Examples include bonds issued by mortgage lenders like Ginnie Mae, Fannie Mae. They are corporate mortgage lenders, and Freddie Mac, as well as other agency bonds issued to finance operations and raise money for special projects. So we have studied like corporate bonds, government bonds, municipal bonds and agency bonds. And there are also international bonds. So marketed simultaneously in several countries. So that is why it is international bonds more than that country. Usually by London branches of international banks and security dealers. What is debenture bonds? So debenture bonds are bonds that are not backed by any specific asset as collateral. It is a plain bond. There will be no secured collateral things of thing. The only backing to the bond is the company itself. On the faith of the company, you have to invest that. Because of the lack of specific assets pledged as collateral, only companies that have a very high credit rating and a large amount of public confidence can issue debenture bonds. Also, to take into account the additional risk, these bonds will most likely have a higher interest rate than collateralized bonds. Although no assets are mortgaged as security for the bonds, debentures are secured by the full faith and credit of the issuing firm. What are income bonds and serial bonds? So let's understand that. The income bonds pay interest only if the company achieves a certain level of income. So if that company achieves only income, then only they will pay the interest. So that is the condition for these income bonds. These bonds are obviously riskier for the purchaser of the bonds because the payment of interest by the issuer is not guaranteed. And what are serial bonds? Serial bonds are bonds issued so that they mature over a period of time. So they will not, for example, if they are issuing some 1 lakh number of bonds and maybe 20% of those will be maturing in 2 years and the remaining maybe maturing after 2 years, or each 20% will mature after 2 years and then third year, fourth year, fifth year, like that. Some of the bonds mature each year, which enables the issuer of the bonds to retire the bonds over this period of time without the need for a single large cash payment. So in the bulk issue, they get the cash flow and they put it for financing the assets. But if that all the bonds are maturing on the same date of maturity, so the company, the corporate who issued the bond, they have to be in trouble or look for another debt arrangement. Okay, if they don't have cash flow. But this serial bonds issue will give them some relaxation. So they can gradually, every year, they can find the resources and settle it and retire the bonds over this period of time. Let's see one CMA adapted question. Serial bonds are attractive to investors. Why? Because there are 4 options. All bonds in the issue mature on the same date. We have just seen that it is not the case. So A is wrong. The yield to maturity is the same for all bonds in the issue. The yield to maturity is the same. It cannot be because different maturity. So the yield to maturity will be, it has to be different. The investors can choose the maturity that suits their financial needs. Sounds like reasonable and good, because different maturity is there. The investors can choose the maturity that suits their financial needs. And let's see what is the option D. The coupon rate on these bonds is adjusted to the maturity date. It's not necessary. So there is C. So investors can choose the maturity that suits their financial needs. So as serial bonds, their key feature is about the maturity only. Mature at different times. Investors can choose the maturity that suits their financial needs. Another question. Which one of the following characteristics distinguishes income bonds from other bonds? So we just studied about income bonds. So let's see the characteristics listed as A, B, C, D options. The bondholder is guaranteed an income over the life of the security, which is not the correct thing. Okay. And B, by promising a return to the bondholder, an income bond is junior to preferred and common stock. So it is not promising a return to the bondholder. Okay, so that is also, B is also wrong. And income bonds are junior to subordinated debt, but senior to preferred and common stock. There is no rank issue in the income bonds because what we have studied about income bonds is that there is no guarantee of the interest income if the income for the corporation is not done, it's not achieved. So it is not about a liquidity. So that is the thing, okay? And there is nothing sort of junior subordinate class appears for the income bond. And what is the D option? Income bonds pay interest only if the issuing company has earned a sufficient level of income. This is exactly what the definition says. So option D is. So what are call provisions like callable bonds? Callable bonds, some bonds are issued with a call provision, which enables the issuing company to call the bonds. That means repurchasing, call back, repurchase them prior to its actual maturity for its redemption. Maybe it is a 5-year bonds, so on the 3rd year or 4th year they can call back and redeem it at their option. Whatever, when they have fund, they can do it. Why do they? Because when they have fund and they get because that fund is idle, so they can get back the bond because they will earn from the interest to be paid for the bonds. So which will be better than depositing the fund in the normal banking. Okay, so that is how they do that. This is very beneficial to the issuer because the issuer can call these bonds, retire them, if the interest rate in the market falls below the rate that they are paying in interest on the bonds. This is also another advantage. If they have this such provision, suddenly if the market rate of interest is falling down, then the bond rate that they are paying to the bondholders. So what is beneficial for them is to take back the bond, to call back the bonds and take the same money from the market which is cheaper. So that is the idea. Such a call provision is at the same time the opposite is detrimental to the investor because the issuer can recall the bond when market interest rates decline. It is usually exercised only when a company wishes to refinance high interest debt. But at the same time, the investors who are holding the bonds, they will be losing the future income because they get the cash flow again. But market is very less, so they cannot invest for the same rate of the return reward. Okay, so that is the thing. And similar to callable bonds, it is puttable bonds. So this is similar to callable, okay, except that the option to retire the bond belongs to the purchaser of the bond. So there it was the issuer, the issuing company, and here it is the purchaser of the bond. If certain events occur or if the issuing company violates any bond covenants, so the investor can require that the issuer repurchase the bonds from them. So whatever bonds I am the investor. If I know, if I can prove that the company is not maintaining or violating the rules set forth on the bond covenants, so I can demand them to repurchase the bonds that I hold. So that kind of options will be there. And mortgage bonds have specific assets pledged. So this is like a guarantee. So some specific assets of the corporation will be pledged as for the security of this kind of bond as collateral. This collateral makes the bond less risky to investors because of there is a mortgage collateral is available. It is less risky. And in the event of default, the sale of the asset may cover the remainder of the firm owes and is unable to pay on the bonds. Therefore, mortgage bonds carry a slightly lower interest rate than debentures. Convertible bonds. Convertible bonds may be converted by the bondholder into a stated number of shares of common stock anytime during the bond's life. For example, if they have $1,000 shares and the convertibility, the issuing company might say that okay, for each bond you can have 50 shares stock. So that is like that after a certain period of time. So this is very advantageous provision for the holder if the price of the firm's common stock increases significantly. This is advantageous only if the price of common stock increases. If it decreases and so then it is not attractive. Okay. As a result of the significant potential benefit to the holder, this provision results in a significant reduction of the interest rate paid by the bond. If it is attractive, then actually the interest rate, the issuing company for this kind of bond, they can reduce the interest rate also, because of the convertibility options are there, and if that issuing company's stock, common stock, is very promising and a stable growth, so people will be attracted for that. So for example, NSM convertible bond, so the maturity is 10 years bond and it has got coupon rate of 10% and conversion ratio is 50. That means 50 shares, 50 stocks can be per bond, can be converted, and face value of that bond is $1,000. So if you do the calculation, the current market price of NSM convertible bond, maybe let's assume that it is $950 current market price, and current market price of NSM stock in the market is $17. So these are the given values, let's say, from the current market. And if we do the calculation, like conversion price is, so we have 1000 and that is 50 ratio. So if you do that, it will be $20 the conversion price. But from there we clearly know that market price is only 70, whereby instead of converting, it is attractive for the investor to buy from the market that shares. So even if we calculate that with the $17 the market price, that 50 stocks after converting, we get the value of $850. Subordinated debentures are bonds that will not have the first claim to the assets of the company in case of a bankruptcy. They are subordinate to the senior and junior. So that is the thing. This is because these bonds are subordinated, that is inferior to other debts that the company has. In case of bankruptcy, all superior debts will be settled before subordinated debentures. Because of this additional risk, subordinated debentures will generally pay a higher rate of interest than unsubordinated debt. And zero coupon bonds. Zero coupon bonds do not pay any interest. So the interest rate is zero. That's why it's called zero coupon. But they sell at a price significantly less than the face value. So the discounted value. The large discount on the sale of the bonds offsets the fact that there is no interest. Because people will still buy these bonds, though there is no interest, zero coupon bonds will carry, but still because they get the instrument at the good discounted rate, upon maturity they can get the face value, so that is there, like kind of discounting checks, things like that, and that is the benefit. The final maturity value, the present value of the final maturity value has to be calculated, and if it is better than the market rate of return, so that is attractive for the investor. In a sense, all of the interest is withheld to maturity and paid at that time at the maturity. That is what discounted. The advantage to the issuer is that there is no cash outlay for the payment of interest. So periodical payment of the coupon rate is not necessary. Okay, this works in much the same way as discounted interest on a bank loan or like discounted check, bill of exchange, things like that. Indexed bonds have an interest rate that is indexed to some other measure. That means it's kind of linked bonds, index linked bonds, such as the price index or a general economic indicator. So they are also called treasury inflation protected securities in the US that pay interest that is linked to an underlying index, such as the consumer price index. Index linked bonds are issued by governments to help mitigate the impact of inflation, paying a real yield plus accrued inflation. These bonds are beneficial to investors because they are less volatile than normal bonds, and the risk involved with uncertainty is reduced because it is linked with the inflation. International bonds. There are two types we've seen. One is foreign bonds Another type is called Euro bonds. Foreign bonds are issued in a single country, not the issuing corporation's home country. So, and are usually denominated in the currency of the country where they are sold. So that is the thing. And Euro bonds are sold in multiple countries, but all are denominated in single currency. Usually the currency of the issuer's home country, not the country where the bond is primarily sold. Example, a US company may issue Euro bonds denominated in US dollars in many countries. Euro bonds may be cheaper than issuing the bonds in the home country because there may be lower registration and reporting requirements related to government regulations. All bonds have a stated maturity date. A term bond has a single maturity date at the end of its term. A serial bond matures in stated amounts at regular intervals. A bond often is bought and sold during its lifetime. At maturity, the bondholder receives the par value of the bond. That is, if $1,000 bond is worth $1,000 at the maturity. But present value calculation is important in order to see what will be that the future redemption of that bond value today in order to calculate. Bond duration gives an approximate sensitivity of bond portfolio values to changes in yield to maturity. Bond duration considers how the price of a bond changes in response to yield changes. The best interpretation of duration is the approximate percentage price changes for a $1 change in yield to maturity. There are three formulas to calculate this bond duration. One is Macaulay duration and modified duration and effective duration formula. Effective duration formula is more used in the calculation. You can see also with some examples. Consider a 10-year semi-annual interest-paying bond with 9% coupon that is currently priced at $1,067.95 to yield at 8%. If the yield declines by 50 basis points, 100 basis points equal 1%. That means if yield is declining 1%, that means it becomes 50 basis points, so that means it is become 7.5% the yield rate. So the price of this bond will raise to 1,104.22 because the yield is reducing, the price will be increasing. If the yield increases by 50 basis points to 8.5%, the price will fall at $1,000 to $1,033.24. So using this formula, the effective duration of the bond can be calculated. The effective duration of the bond formula is the bond price when yield is falling minus the bond price when yield is rising, and that has to be divided by 2 into the current price into the change in yield in decimal form. So given the above value, so if you put it into this formula, so you get 6.65 as the effective duration value. One multiple choice question exam type. Which of the following scenarios would encourage a company to use short-term loans to retire its 10-year bonds that have a 5-year until maturity? So we can see the company expects interest rates to increase over the next 5 years. Is that the reason for using the short-term loans to retire? Or interest rates have increased over the last 5 years? Or interest rates have declined over the last 5 years? The last option, the company is experiencing cash flow problems. So the option C, interest rates have declined over the last 5 years, could be the best reason why it would encourage a company to use short-term loans to retire its 10-year bonds that have a 5-year until maturity. Because option A is wrong because the company will not benefit from short-term loans if interest rates rise. That will not be the case. And option B also wrong, because the company should maintain the existing debt if prevailing interest rates are higher. So they will have to maintain that. Okay. And also the company increases the cash flow problem by shifting to short-term loans. So it will again increase the cash flow problem if they shift to short-term loans. So that will not be the reason for encouragement. So option C is correct. And bond security. Bonds may be issued on a secured or unsecured basis. A secured basis, like we studied earlier also, the collateral security can be, or pledging an asset can be standing as a security. A secured bond is one that is backed by the collateral of a specific asset. It can be inventories or real estate or fixed assets or revenues created from a specific project. From one particular project, all the revenues can be directed as a security account. That thing. A secured bond provides the investor with a lien or creditor claim against an asset in the event of default. An unsecured bond or debenture, which is a plain debenture, is backed only by the good faith, integrity and credit worthiness of the borrower and offers no specific collateral. So that is the only possibilities. When holding an unsecured bond, an investor has only a general claim against the assets. They cannot have any seniority or privilege claim for that. Because unsecured bonds have greater risk than secured bonds, they usually pay higher yields. And bond ranking. With the objective of affecting priority in liquidation, bonds may be classified as equal or senior or junior or subordinated in relating to other debt obligations. If a bond issuer in default has both secured and unsecured bonds, so the secured bondholders are paid off first, so they get priority. That's what the bond ranking. Secured loans get top priority. Unsubordinated debenture holders become general creditors and are paid off after the secured debt holders are paid. So only after the secured debtor is paid, then they have become the general creditors rank. Subordinated debentures are paid off after the general creditors. That means after the unsubordinated creditors are paid first, then subordinated debenture holders paid. Okay, now we'll have to understand the bond rating, because there are various rating agencies, credit rating, and they give the company rating as well as the bond rating. They can do. The rating agencies are doing that. Bond ratings allows an investor to assess the general risk of buying a bond before making the actual purchase. So these ratings are important. Based on that, they can guess the risk level of that bonds. Bond issues often are rated by credit agencies based on numerous factors. What are the numerous factors? It could include the current financial status of the issuing company, future financial prospectus of that company, looking at the trend and market feedback and other things, and collateral, if they have got any collateral secured pledging any assets as collateral for issuing this bond, if there is any security. Based on these kind of data that they give, they weigh this rating, credit rating, and they publish that ratings. And Moody's, Investor Service, and Standard and Poor's are two well-known credit rating agencies or services. So here I put one table showing and how the ratings are there, A and AAA, like that. The alphabetic order AAA stands is a very good rating, highest in quality, and the lowest is in the down, C, D, like that. And from the grade point of view, you can say good investment is good, suitable for investment, high quality investment, or high quality investment, then strong investment, and medium grade, speculative junk grade, kind of like this kind of ratings are there. Okay. And still in ranking, some of the key points that students should remember: the bond ratings apply to the bond issue, not the company. So bond rating, company rating is different, but similar pattern. Okay, that's understood. And US Treasury bonds are rated AAA, like in the schedule, because they are backed by the full faith and credits of the US government. So ratings may be adjusted either up or down during the lifetime of a bond. A downgraded rating means that future issues will need to offer higher interest rates to attract buyers. What does that mean? A bond during that lifetime also can be, the ratings can be changed, because if the company performing well and they satisfy all the covenants and needed ratios, maintaining good management things and all these things, based on this kind of feedback, if rated the ratings was lesser, it can be improved. That the rating agency can take that to improve it. Bonds with AAA ratings have the lowest rates of interest because they are high rate, so the risk is very less. So the interest rate also less. So that is how the vice versa. It will be for the case of lowest ratings. Because the default risk associated with junk bonds, they are higher yield bonds. Okay, because the risk is more, so the yield is also more. Junk bonds have a greater chance of default. Okay, they have high yield, but greater chance of default. But in some circumstances, they also may be an emerging entity and provide a highly profitable return. Provision for redeeming, like retiring a bonds. Bonds can be retired at final maturity by making a single payment of principal plus the last interest payment, that is one. Or another way, that it can be issued as a callable bonds, and that's why that it can be repurchased in the market upon that certain date or condition. So it will be issued as a callable bonds by the issuer at a specified price or series of set prices before maturity. Or it can be like a convertible bonds. So that will be by way of converting the bonds to the stock equity. So it will be redeemed, the bonds will be redeemed and it will become a stock equity. And it may be converted into equity, that's why. Securities of the issuer at the option of the holder under certain conditions is possible, like this kind of convertible bonds. Many bonds carry a sinking fund also. This is also one way of redemption, like guaranteeing redemption possibilities, that the issuing company will keep on depositing funds in a sinking fund account, and that will be periodically accumulated and it will be used for the settlement. The company to make periodic cash payments to a bond issues trustee or whoever is that, in order to retire bonds at maturity or on a periodic basis. What are the advantages of issuing bonds? Advantages to the issuer of bonds include, so no loss of control or ownership. For the issuing company, it is better because there is no share in the ownership of the company. Bondholders are not owners and thus no control voice in the running of the company, no voting rights for them. The total cost of the bonds is limited and known because the interest rate is constant. Because the interest rate is constant attached to the bond face value, and it is always known already. So even the management can plan things. And even for the investors, it is a known thing, so that they can treat that it is the expected return of periodically. Whereas in the share, common share, even preferred share, but the return is not sure about that. Additionally, if the company is very successful, the bondholders do not receive any additional payments above the stated interest. So that is an advantage for the uh, bond issuers. The interest that is paid on the bonds is tax deductible because it is interest income. So before distributing the net income, so the interest can be deducted before even paying the tax. So that is tax deductible as an expense of the business. So the greater the tax rate, so the greater the advantage here. Okay, the lesser the cost of that will be there. This is an advantage because dividends that are paid to shareholders are paid after taxes and are not deductible for tax purposes. If the bonds are callable or otherwise can be retired yearly, there is flexibility for the company to eliminate the interest payment if there is no longer a need for the financing. If it is callable bonds, so it is to the advantage of the corporate which is issuing these bonds. So they can manage their financial leveraging accordingly also. Okay. What are the disadvantages of issuing bonds? One is that the cost of servicing the bonds because the interest is fixed and required. So that is one thing because we have to pay fixed interest, and also there is a cost involved on that. Even in periods of losses and low cash balances, the interest must be paid. If it is not paid on time, the company breaches its contract with the bondholders and defaults on the bond, that is the loan, which can lead to bankruptcy and liquidation of the firm. In comparison to equity, this is a disadvantage because dividends never have to be paid. And increased risk to the firm because of the chance of default on the debt. So it is increasing the risk also. Okay. As the level of debt grows, the interest rate on the next loan and return required by shareholders will increase. In times of low income or poor cash flows, this interest requirement may become too large for the company. It will be a big headache, big risk for the company, big burden for the company. The maturity of the debt will result in a large cash payment. So that is also, unless if you are issuing a serial bonds and it's a different maturity, that is at least a manageable level. But here, when the whole maturity falls on one particular day, and it's a huge financial risk, the needs to be made at one time in the future also. That is to be done. So maybe by another debt financing, they will have to mobilize. Advantages and disadvantages of bonds can be easily memorized by this image. It was given in a very good website called Investopedia, thanks to them. So receive income through the interest payments, that is the advantages, and hold the bond to maturity and get all your principal back, and profit if you resell the bond at a higher price. So that is tradable also. And disadvantages, bonds pay out lower return than stocks. So that is the thing. It is known thing, but it is a disadvantage. And companies can default on your bonds also. And bond yields can fall because of the market expected rate of return also. So some CMA adapted question. Which one of the following statements correctly compares bond financing to its alternatives? A. A bond with a call provision typically has a lower yield to maturity than a smaller bond without a call provision. A convertible bond, this means that it is able to be converted into common share, must be converted to common stock prior to its maturity. A call provision is usually considered detrimental to the investor. A sinking fund prohibits the firm from redeeming a bond issue prior to its final maturity. Actually, a call provision is usually considered detrimental to the investor is the right statement. So, this is a correct one compared to the other aspects we will see. So, a call provision is detrimental to the investor. This is so that if interest rates go down, the company can buy back the bonds at the option. Because if the interest rate, they need not pay the higher rate of interest to the bondholders. So what they do, if there was a call provision, they can call back and take less needed fund in the market because the interest rate is less in the market. So this leaves the investor with the reinvestment risk of not finding suitable reinvestment opportunities. Other types of bonds. So these are short notes for your understanding. Maybe you may face some particularized questions so that you can understand. A plain vanilla bond is a bond without any unusual features. It's like a plain debenture. It is one of the simplest form of bond with a fixed coupon and a defined maturity and is usually issued and redeemed at a face value. It is also known as a straight bond or a bullet bond. A zero coupon bond is a type of bond where there are no coupon payments made. That means no interest is made. It is not that there is no yield because the zero coupon bonds are issued at a price lower than the face value. It is sold at a discounted value. Okay. And deferred coupon bond. Deferred coupon bond is a blend of a coupon bearing bond and a zero coupon bond. It is only the payment, interest payment is in effect, it is deferred, delayed. These bonds do not pay any coupon in the initial years and thereafter pay a higher coupon to compensate for no coupon in the initial years. That's the thing. After a certain period, then the company started paying interest. So why? Because when they raise the debt financing, it is for the resourcing of the assets. So maybe the company need to get certain income level. After that, they will be comfortable to pay, and so that time they will pay with a higher interest rate in order to compensate that the initial period of zero coupon bonds. So that is the idea. For example, construction companies and all example of company which may issue such type of bonds include construction companies, because after certain period only then they get the contractual payment and they are ready to give the interest payments. And a step-up bond. These are bonds where the coupon usually steps up after a certain period. They may also be designed to step up not once but in a series too. Such bonds are usually issued by companies where revenues, profits are expected to grow in a phased manner. These are also called as a dual coupon or multiple coupon bonds. Step down bonds are just the opposite of step up bonds. In the beginning, it will be better rate and then it will be slowly getting it down. These bonds where the coupon usually steps down after a certain period. They may also be designed to step down not once but in a series too. Such bonds are usually issued by companies where revenues, profits are expected to decline in a phased manner. This may be due to wear and tear of the assets or machinery as in the case of leasing. A floating rate bond is a bond that has a variable interest rate versus compared to a fixed rate note which has an interest rate that doesn't fluctuate. This interest rate is tied to a short-term benchmark rate such as LIBOR rate or the Fed funds rate plus a quarter spread or a rate that holds steady. So normally, certain items are like, LIBOR rate plus 1% kind of spread only. So based on that way, so these rates are getting it floated because the LIBOR rate is varying according to the market. Thank you. This is end of the introduction to debt financing, that is bonds, and we have seen all the computation as well. And I have my portal for practicing questions which will be released once the students confirm that they have completed for chapter A and chapter B up to this part. And then the next lecture will continue about the equity and also the derivatives. Thank you very much. எல்லா போடும் இறைவனுக்கு.